Okay, picture this. Decentralized finance, DeFi. Just a couple of years back, it was, barely $1 billion locked up. Tiny, really. Fast forward maybe less than 2 years, boom, over $85 billion. That kind of explosion, well, it's not just numbers on a page.
Absolutely not. It's a massive signal.
Right. It shouts that there's huge interest, massive potential maybe, in getting your crypto assets to actually do something for you, to generate passive income.
That growth, it's not random. It shows this real shift in how people are thinking about digital assets. It's moved beyond just, hodling.
Yeah, people want yield now.
Exactly.
Yeah.
And the sources we're diving into today, they really zero in on two of the biggest ways people are chasing that yield: crypto staking and yield farming.
Perfect. So for this deep dive, we've waded through a whole stack of articles, research papers, basically looking at how these things actually work.
The mechanics, yeah.
The mechanics, the opportunities, the potentially juicy returns, but also, crucially, the risks. And there are definitely risks.
For sure. Significant ones.
We're also looking at security stuff and even the regulatory side, which seems to be getting, well, more complicated by the day.
It's a moving target.
So our mission here is pretty straightforward. Cut through the noise, pull out the really vital info, and basically give you a shortcut. Help you understand the potential, yes, but just as importantly, the serious downsides. Help you get informed without needing a PhD in DeFi.
Think of it like this. We've done the reading, we've synthesized it, and now we're breaking down what actually matters so you can figure out if these strategies make any sense for your own situation, your own stomach for risk.
All right, let's jump in. First things first. Passive income in crypto. What does that even mean? How's it different from, say, getting dividends from stocks?
Well, the core idea is the same, right? Earning money from your assets without actively, constantly working for it.
Like stock dividends or bank interest, theoretically.
Exactly. You put your assets to work. But how they work is the big difference.
Okay, so the engine is different.
Totally different. Traditional passive income. That runs on companies making profits, banks lending money, maybe rent from property, established systems.
Right.
Crypto passive income, especially staking and yield farming, it lives in DeFi, runs on blockchains, smart contracts. The whole point is often to cut out the middlemen, the banks, the brokers.
And that's where the potential for higher returns comes from. Fewer middlemen taking a cut.
That's a big part of the theory, yeah. By decentralizing, you can potentially capture more of the value generated. And one source, CoinMetro, mentions crypto lending too, another passive income route. But today, yeah, we're really focused on staking and yield farming because they're sort of unique DeFi mechanisms.
Got it. So your digital money makes money, but through code and networks, not Wall Street. Let's unpack staking first. What is it, fundamentally?
Okay, staking. It's all about participating in a specific kind of blockchain, one that uses what's called proof of stake, or POS.
Not proof of work like Bitcoin.
Exactly. Different system. The sources basically define staking as locking up your crypto, holding it in your wallet to help run the network. You're validating transactions, securing the whole thing. You're actively participating.
Okay, participating. But why do these POS networks need people to stake? What's the actual function?
Well, think about Bitcoin's proof of work. You have miners using tons of electricity, powerful computers, solving complex math problems to add blocks.
Right, the whole mining industry.
POS gets rid of that. Instead of computational power, your power comes from how much crypto you're willing to stake, to lock up as collateral. By staking, you become eligible to be chosen as a validator.
A validator?
Yeah, these validators are the ones who propose new blocks of transactions, confirm their validity, and add them to the chain. So staking is what secures the network, keeps it honest, makes sure everyone agrees on the transaction history. It replaces the energy-hungry mining part.
So I put my coins up, kind of like a security deposit, to get a chance to do this validation work and keep the chain secure. How does it decide who gets picked, and how do I get paid?
Generally, the more you stake, the higher your chances of being selected to propose the next block. It's often proportional.
Makes sense. More skin in the game, higher chance.
Exactly. And when you're chosen, and you do your job correctly, you validate good transactions, stay online, follow the rules, the network rewards you. Usually these rewards are paid in the network's own cryptocurrency.
And the amount varies.
Yeah, it depends on how much you staked, maybe how long you've been staking. Sometimes network conditions like the total amount staked by everyone else play a role too.
Okay, sounds straightforward enough conceptually. Put crypto to work, secure the network, earn rewards. But you mentioned running a validator. That sounds like it might be technically demanding or expensive.
Yeah, that's a really key point. Running your own validator node directly, For a lot of the big POS chains, the barrier to entry is pretty high.
How high?
Take Ethereum, for example. To be a full validator on its POS chain, the Beacon chain, you need to stake 32 ETH.
32 ETH. Okay, depending on the price, that's a lot of money for most people.
A very significant amount. Definitely puts direct validation out of reach for your average crypto holder.
Yeah, okay, so if I don't have, say, $100,000 plus just lying around for ETH staking, what are my options? How can regular folks get involved?
Good question. This is where different ways to participate come into play. The sources lay out a few main models. First up, you've got intermediated staking, often called staking as a service or STAS.
STAS.
Yeah. Basically, you use a third party. Could be a big crypto exchange, could be a specialized staking company. They take deposits from lots of users, pull them together, and run the validator nodes for you. They handle the tech side.
Convenient. Any catches?
Well, one thing the Hogan Lovells source points out is the distinction between staking and custody. Some STAS providers might be custodial, meaning they hold your private keys for you. Others might be non-custodial. The act of staking itself doesn't require giving up custody, but the service model might involve it. That's an important difference.
Okay, so STAS lowers the barrier, handles the tech, but you might be giving up control of your keys depending on the provider. What about staking pools? Similar idea.
Similar concept, pooling funds, yeah. But staking pools are often presented as being maybe more decentralized or community-driven than the big exchange offerings. You contribute your crypto to the pool.
And what do I get back?
Usually you receive some kind of token that represents your share of the pool, both the underlying assets and the rewards being generated. These pools can sometimes be run entirely by smart contracts, which add automation, maybe transparency, but also smart contract risk, which is a whole other topic we need to get into.
Right, more code, more potential bugs. Okay, and then there was liquid staking. That sounds different. What's the deal there?
Liquid staking is pretty clever, actually. It tackles one of the main downsides of traditional staking head on. Your money being locked up.
Illiquidity, yeah.
Exactly. So with liquid staking, you deposit your assets, say ETH, into a liquid staking protocol like Lido. Your ETH gets locked and staked on the main blockchain, earning rewards. But the protocol instantly gives you back a different token, like STIF in Lido's case.
STIF? What's that?
It's a liquid staking token, an LST. It represents your staked ETH plus the rewards that are accumulating. And the key part is, this ETH is liquid. You can trade it, lend it out on other DeFi platforms, use it as collateral on borrowing protocols, all while your original ETH is still staked and earning the base rewards.
Ah, okay. So my capital isn't just stuck. I have a tradable token representing my staked position. That has a lot of flexibility. Definitely see the appeal.
It unlocks capital efficiency, lets you layer strategies. It's a big reason why liquid staking has become so popular.
So which coins are we mostly talking about for staking, and where do people do it?
Well, lots of the major blockchains now are proof of stake. The sources flag the big ones. Ethereum, obviously, after its big merge. Then you have Cardano, ADA, Polkadot, DOT, Tezos, XTZ, Solana, SOL, Cosmos, Atom, quite a few. Each one has its own little quirks in how staking works, the rewards, how long it takes to get your coins back if you unstake.
In platforms.
You've got direct staking if you have the capital and tech know-how. Then the big exchanges, Binance, Kraken, Coinbase, offer easy stasis options. And for decentralized solutions, you have liquid staking protocols like Lido, Rocket Pool, and countless smaller independent staking pools and specific protocol interfaces. Lots of choices.
Okay. And the million-dollar question, or maybe the 5-20% question, what kind of returns are we looking at? What's realistic?
Yeah, the returns, usually shown as APY, annual percentage yield, they really do vary. Depends heavily on the specific coin you're staking, how many other people are staking it. Sometimes more stakers means the reward pie gets split more ways, lowering individual yield and the platform or pool you use.
So typical range.
The sources generally mention figures anywhere from, say, 5% up to maybe 20% APY. For specifics, you might see ETH staking, often quoted around 5-7%. Polkadot maybe higher, 10-14%. Cardano perhaps 4-6%. Tezos maybe 6-8%. It changes, but it's usually framed as a way to earn a relatively steady yield driven by the protocol itself.
Those percentages definitely catch the eye compared to, a savings account right now. But let's talk about the flip side, the risks. What can go wrong with staking?
Okay, risk number one, and it's unavoidable in crypto, market risk. You're staking, let's say, ADA. You're earning maybe 5% more ADA. But if the price of ADA crashes by 30%...
your total value in dollars still goes down.
Exactly. The yield you earn might not be enough to offset a big price drop in the underlying asset. You're exposed to the volatility of whatever you're staking.
Right. Earning 10% on something that drops 50% is still a net loss. What else?
Another big one, especially for non-liquid staking, is that illiquidity we touched on. Lockup periods, or maybe unbonding periods.
Unbond.
Yeah, when you decide you want to stop staking and get your coins back, there's often a waiting period enforced by the protocol. Could be days, could be weeks.
So you can't just instantly sell if the market tanks or you need cash.
Nope. Your funds are locked during that unbonding time. You're stuck watching the price move. Liquid staking helps here, but even LSTs like stETH can sometimes trade at a slight discount to the actual ETH price, especially during market stress. So liquidity isn't always perfect even then.
Okay, so market risk, liquidity risk. What about risks tied to the actual staking process, the validating?
Right, this is where slashing comes in. It sounds harsh, and it is.
Slashing.
It's a penalty mechanism built into PS's protocols. It's designed to punish validators who misbehaved or failed to perform their duties properly.
Like what?
Going offline for too long is a common one. Or worse, actively trying to cheat the system, like validating the same transaction twice double signing. If a validator does something malicious or is negligent, the protocol can automatically slash, basically destroy or confiscate a portion of the crypto they have staked.
Wow, so you could actually lose your principal stake.
Yes, that's the risk. It's a security feature for the network to keep validators honest, but it's a direct financial risk for the staker. If you're staking directly, or if the pool or stays provider you're using gets slashed, you could lose some of your initial capital.
That's critical to understand. Makes choosing your validator or provider really important.
Absolutely crucial. You need to understand their track record, their infrastructure, maybe even if they offer any kind of protection or insurance against slashing. Some do, some don't. And finally, there are just the general risks. If you use a custodial service, there's counterparty risk. What if the exchange gets hacked or goes bankrupt? And basic online security, keeping your own wallet and accounts safe.
Okay, that paints a pretty clear picture of staking. Securing the network, earning rewards, but with real risks around price, lockups, and potentially losing your stake through slashing. Now, let's switch gears to yield farming. This always feels like the wilder cousin of staking. Higher potential rewards maybe, but more complex, more dangerous.
That's a pretty good way to put it, yeah. Yield farming, or liquidity mining as it's often called, it operates a layer up, you could say. It's less about securing the base blockchain itself and more about providing fuel for the applications running on the blockchain, specifically DeFi applications.
Fueling DeFi apps? How?
Mostly by providing liquidity. Think about decentralized exchanges, DXs, or DeFi lending platforms. They need pools of assets readily available for users to trade against or borrow from.
Okay.
Yield farmers are the ones who deposit their crypto into these liquidity pools.
So I put my crypto into a pool.
Typically, yes. And usually you deposit a pair of tokens. For example, on a DEX like Uniswap, you might deposit ETH and a stablecoin like USDC into an ETHC pool.
Why pair?
We'll get into the mechanics of automated market makers, but basically the pool needs both sides of the trading pair to facilitate swaps. When you deposit, say, $1,000 worth of ETH and $1,000 worth of USDC, you get something back in return.
What do I get?
You receive special tokens called LP tokens, liquidity provider tokens. These LP tokens essentially act as a receipt representing your share of that specific ETHSDC pool.
Okay, I have LP tokens now. Is that the farming part?
Not quite yet, usually.
Right.
That's the liquidity providing part. The farming often comes next. Many protocols incentivize providing liquidity by allowing you to take those LP tokens you just received and deposit or stake them somewhere else, maybe, in a separate farm contract provided by the DEX.
Stake the LP tokens.
Yeah. And by staking those LP tokens, you start earning additional rewards. Often these rewards are paid out in the platform's own native governance token. So you're earning trading fees from the pool and farming extra tokens on top.
Layers upon layers. Okay, so I deposit ETH and USDC, get ETH USDC LP tokens back, then stake those LP tokens to earn, say, UNI tokens if I'm on Uniswap.
That's the basic flow for many yield farming strategies, yes. And these liquidity pools, they're the absolute bedrock of most DeFi trading. They're essentially just pools of tokens locked in a smart contract. But they enable everything. They allow people to swap tokens instantly, 204/7, without needing a traditional order book like on a stock exchange. You don't need to wait for a specific buyer or seller to match your price.
You just trade directly with the pool.
Exactly. The pool always provides the other side of the trade, thanks to the way it's structured. And this structure also allows for automated price discovery.
How does it figure out the price without buyers and sellers bidding?
That's the magic, or the math, of automated market makers, AMMs. These are the smart contracts that control the liquidity pools. They use formulas to automatically set the price based on the ratio of the two assets in the pool.
Formulas.
The most famous one is Uniswap's XY equals K formula. The quantity of token X multiplied by the quantity of token Y must always equal a constant value, K.
Okay. How does that set a price?
Well, the ratio of X to Y in the pool implies a price. If someone buys a bunch of token X from the pool using token Y, the amount of X goes down and the amount of Y goes up. To maintain that constant K, the formula dictates that the relative price of X must now be higher. The AM automatically adjusts the price with every trade.
So if lots of people buy ETH out of an ETHUSDC pool, the pool has less ETH and more USDC. The formula makes ETH more expensive within that pool to encourage trades the other way, keeping it balanced relative to the constant K.
Precisely. It's an elegant, automated way to maintain liquidity and pricing. And the people who provide the assets, the liquidity providers, LPs, they earn fees on every single swap that happens in their pool, usually a small percentage of each trade.
Okay, so LPs earn trading fees. Where does the farming reward come in again?
Yield farming often adds an extra layer of incentive on top of those trading fees. The platform itself might distribute its own tokens like Unini for Uniswap or Cake for PancakeSwap to people who stake their LP tokens. It's a way to attract more liquidity providers, make the pools deeper, which means better prices and less slippage for traders. It bootstraps the platform's growth.
Got it. Fees from trading plus bonus tokens from farming. Makes sense why people chase it. Are all these pools the same?
Oh no, lots of variety. The sources mentioned the standard 50-50 value pools like Uniswap pioneered. Then you have pools optimized for stablecoins, like on Curve Finance. Because stablecoins like USDC and DAI should trade very close to $1, these pools use different formulas to allow huge trades with minimal price impact or slippage, and minimal impermanent loss, which we definitely need to talk about.
Right, impermanent loss, we'll get there. Any other pool types?
Yeah, there are multi-asset pools, like on Balancer, where you can have more than 2 tokens, maybe different weightings. Some platforms offer single-sided staking where you only provide one asset. And newer innovations like concentrated liquidity on Uniswap v3 let LPs provide liquidity within specific price ranges, potentially earning fees more efficiently, but also taking on different risk profiles.
Complex. And the platform's doing this?
The big names come up again and again. Uniswap, still a giant. Curve, king of stablecoin swaps. Balancer for custom pools, SushiSwap, which famously forked Uniswap and added aggressive yield farming early on, PancakeSwap, huge on the Binance Smart Chain, and then you have yield aggregate or optimizers like Yearn Finance.
Optimizer?
Yeah, platforms like Yearn automatically move your deposited funds around different yield farming protocols, constantly seeking the highest returns and auto-compounding your earnings for you. Takes some of the manual work out, but adds another layer of smart contract risk.
Wow, okay. Aggregators aggregating yield from farms built on pools. It's turtles all the way down. So the big draw here is clearly the potential for high returns, right?
Absolutely. That's the main allure. You're potentially stacking multiple yield sources, trading fees, maybe lending interest if it's a lending pool, and crucially, those often generous farming rewards paid in platform tokens. The combined APYs can at times look astronomically high compared to anything in traditional finance or even basic staking.
Nominal APYs in triple or even quadruple digits sometimes get thrown around, although those rarely last.
Exactly. Those super high yields are often temporary, maybe during a platform launch to attract initial liquidity, and the value of the reward token itself can be very volatile. But even sustainable yields can potentially be much higher than staking.
And compounding plays a big role too.
Huge. Because you're earning rewards constantly fees from every swap. Farming tokens accumulating, you can frequently reinvest those earnings back into the pool or into other opportunities. Harvesting your rewards and adding them back to your position can lead to that exponential growth curve, especially if automated by the platform or an aggregator.
Okay, multiple income streams, compounding, sounds great. But we know there's no free lunch, especially in crypto. What are the major risks here? This feels riskier than staking.
It generally is, yes. The risks are more varied and in some cases much more severe. The absolute #1 risk, the one that keeps DeFi users up at night, is smart contract vulnerability.
Because your money is literally sitting inside code, someone wrote.
Precisely. Every pool you deposit into, every farming contract you stake in, it's all controlled by smart contracts. If there's a bug, a flaw, an oversight in that code,
Hackers can drain it.
hackers can drain it. Or the protocol could malfunction in some other way, leading to loss of funds. And this isn't just theoretical. It happens frequently in DeFi.
Any examples come to mind?
Oh, yeah. The hack and source specifically mentioned the Harvest Finance exploit boom, $33.8 million gone due to a flash loan attack manipulating prices, or Anubis DO turned out to be a $60 million rug pull where the anonymous team just ran off with the funds, likely due to controlling the contract keys. These aren't small numbers.
$60 million just gone. That really hits home. So trusting the platform is trusting anonymous developers' code often.
Or even non-anonymous developers' code. Audits help, as we'll discuss, but no code is perfect. Right? Yeah. So smart contract risk is massive. What else?
Market volatility is still there, right?
Still there, absolutely. The value of the 2 tokens you deposited can swing wildly. The value of the farming token you're earning can also crash. So your overall position value in dollar terms is constantly fluctuating. Regulatory risk is also a factor. Governments are still figuring out how to handle DeFi, and a sudden crackdown could impact platforms or specific activity.
Okay, and then the big one, the weird one, impermanent loss. This term haunts liquidity providers. Break it down for us. What is it?
Right. Impermanent loss, or IL. It's probably the trickiest concept for new LPs to grasp, but it's fundamental. In simple terms, it's the difference in value you experience by providing liquidity compared to if you had just held on to your original assets in your wallet.
A difference compared to just holding.
Exactly. It happens when the relative price of the 2 assets you deposited changes after you've deposited them.
Yeah.
If the price of one coin goes up or down significantly compared to the other, you'll likely experience impermanent loss.
Why impermanent? Does it go away?
It's called impermanent because if the prices of the 2 assets return to the exact same ratio they were at when you deposited, then theoretically the loss vanishes. You'd withdraw roughly the same value as if you'd just held. But
prices don't always return to the starting point.
Exactly. If you withdraw your liquidity while the prices are diverged, that impermanent loss becomes very real, very permanent. You lock it in.
Okay, so it's triggered by price divergence between the pair. How does the AMM mechanism actually cause this loss?
It comes back to that balancing act the AMM performs. Remember, the AMM's formula, XYLK, maintains a relationship between the quantities of the 2 tokens in the pool.
Right.
Now, let's say the price of token A skyrockets on outside exchanges, while token B stays flat. The pool's internal price for token A is now way too cheap compared to the market.
Arbitrage opportunity.
Big time. Arbitrage traders will jump in. They'll buy the cheap token A from the pool using token B and sell token A on the external market for a profit. They'll keep doing this until the price inside the pool matches the external market price again.
And what does that buying activity do to the pool's contents?
It drains token A, the one that went up, out of the pool, and adds more token B, the one that stayed flat or went down relative to A, into the pool. The AMM forces this rebalancing to maintain its formula and reflect the new market price ratio.
So the pool now holds less of the coin that appreciated and more of the coin that didn't.
Exactly. So when you, the liquidity provider, decide to withdraw your share, you're withdrawing from this rebalanced pool. You will get back less of the high-performing asset and more of the lower-performing asset than you initially put in.
Ah, I see. You end up with a less desirable mix of assets compared to if you just held the original amounts.
That's the crux of it. Let's use that tangent example, makes it clearer. Say you deposit 1 ETH in 2,000 USDT when ETH is worth $2,000.
Yeah.
Your total deposit value is $4,000.
Okay, 50-50 value.
Now, ETH moons. It doubled to $4,000. Outside the pool, your 1 ETH is now worth $4,000 and your USDT is still $2,000. Total value of holding, $6,000.
Right.
But inside the pool, arbitrage happened. The pool rebalanced. When you go to withdraw your share, the AMM calculation means you won't get 1 ETH and 2,000 USDT back. The source's math suggests you'd get something like, say, 0.7071 ETH and 2828.4 USDT.
Less ETH, more USDT. What's the dollar value of that withdrawal?
At the new price of $4,000 per ETH, your 0.7071 ETH is worth about $2,828.40. Add the 228.4 USDT you also get back. Your total withdrawal value is about $500,656.80.
Okay, wait. Holding of $6,000, withdrawing from the pool is $500,656.80.
The difference, that roughly 343 cents, that is your impermanent loss. Even though ETH doubled, providing liquidity left you with less total value than simply holding.
Wow. Okay. That makes it crystal clear. It's the opportunity cost versus holding caused by the price divergence and the AMM rebalancing. And it happens if prices go down too, just the divergence matters.
Exactly. If ETH had halved instead, you'd also have IL compared to just holding the halved ETH in the USDT. It's purely about the price ratio changing from when you deposited. The bigger the change, up or down, the the worse the potential IL.
How bad can it get? Is there a scale?
Yeah, the sources provide some useful benchmarks. A 1.25x price change, 25% increase, causes about 0.6% IL. A 1.5x price change, 50% increase, is about 2% IL. And a 2x price change like our sample is nearly 40% IL. And a 10x price change is nearly 40% IL. It ramps up fast with big moves.
25% loss just from price divergence on a 5x move. That's huge. But hang on, LPs earn fees and farming rewards. Don't those compensate for this?
That is absolutely the critical counterpoint, yes. The trading fees collected by the pool and any extra yield farming tokens earned are meant to offset this impermanent loss.
So it's a race, fees and rewards versus IL.
Pretty much. If the pool is busy with lots of trading, generating lots of fees, or if the farming rewards are high enough and the reward token holds its value, then your total earnings can definitely outweigh the impermanent loss. You can end up significantly better off than just holding. But if volume is low, or rewards dry up, or the reward token crashes, IL can eat away at your capital. That's the risk calculation LPs constantly have to make.
Okay. High volume, high rewards needed to beat IL. Are there ways to actively reduce the risk of IL strategies?
Yes, several strategies get mentioned. The most common, and probably safest from an IL perspective, is providing liquidity for pairs of assets that shouldn't diverge much in price.
Like stablecoin pairs.
Exactly. A USD to USDC pool, or DI-USDC. Since they're both aiming for $1, their price ratio should stay very stable. Minimal divergence means minimal IL. You won't get rich from price appreciation, obviously, but you can still collect trading fees from people swapping between stables.
Makes sense. Minimize the cause of the problem. What else?
You could choose to only put a portion of your holdings into a liquidity pool. Reduces your potential IL exposure, but also reduces your potential fearward earnings. Another tactic is just avoiding pairs you expect to be extremely volatile, especially if you think one side is about to moon or dump relative to the other.
Choose your pairs wisely based on volatility expectations.
Right. And focus on pools with consistently high trading volume, because fees are your first line of defense against IL. Or look for pools with very strong sustainable farming rewards, but be wary of unsustainably high APYs as they often collapse.
So seek high real yield from fees or solid rewards.
Precisely. Some sources also mention that newer pools sometimes offer very high initial rewards to attract liquidity quickly, which could potentially outpace IL early on, but that's a riskier, more active strategy. And obviously, just monitoring the prices of your assets and the performance of your pool is key. Knowing when the IL might be getting too high relative to earnings helps you decide when to potentially exit.
There was also a point about long-term holders.
Yeah, an interesting perspective from one source, I think it was Reddit actually. If your plan was always to hold both assets for the very long term anyway, maybe you're less concerned about the temporary fluctuations causing IL along the way. If you believe that over years, the cumulative fees and rewards will significantly outweigh any IL experience during volatile periods, then providing liquidity might still fit your long-term strategy. It depends on your conviction in the assets and the platform.
A lot to weigh up. This really underscores how critical the underlying tech, the smart contracts, are. If they fail, none of this matters. You mentioned smart contract risk as yield farming's big killer. How do platforms even try to make sure their code is safe?
It's a massive challenge, but the main tool is the security audit. Since all the funds are controlled by code, getting that code reviewed by independent security experts before launch, and ideally on an ongoing basis, is absolutely vital.
So they hire external auditors.
Reputable projects do, yes.
Okay.
The a priori source gives a great window into what a thorough audit looks like based on one they performed for a project called Plenty. It's not just a quick scan.
What's involved in a deep audit like that?
They broke it down into 3 main stages. First, specifically checking the smart contract security, looking for known vulnerabilities, potential exploits. Second, a broader review of the smart contract code quality. And third, analyzing the test coverage.
Okay, step 1, security checks. What are they looking for?
They use a whole battery of techniques. Analyzing the code's behavior, checking it against huge databases of known smart contract bugs like reentrancy or integer overflows. Doing symbolic analysis to mathematically check parts of the code. Manual review by experienced security engineers is huge, just reading the code line by line. They even try to simulate attacks based on potential weaknesses they find.
And did they find things in that Plenty audit example?
Oh yeah. They found 15 issues in total. 2 were flagged as high risk, 6 medium, 7 low. The high risk ones, sounded pretty bad things that could let someone bypass core system rules or even allow fraudulent actions, like a bad actor preventing themselves from being kicked out or messing with voting results.
Yikes. Things that could break the whole system's trust. What about medium risk?
Those often related to admin privileges being too broad. Like, could an admin potentially move reward tokens without permission, or skip essential steps in processes like creating new tokens, or undermine voting safeguards? These aren't immediate exploits maybe, but they open doors for abuse or error.
So the audit points these out. Does it also say how to fix them?
Yes, that's a crucial part. A good audit provides concrete recommendations. Maybe changing the contract's architecture for voting, maybe adding time locks or multi-sig requirements for sensitive admin actions so no single person can instantly make critical changes. These recommendations are designed to close those security holes.
Okay, so finding flaws and suggesting fixes. What about the second step, reviewing the code itself? Isn't that covered by security?
It overlaps, but code review is broader. It looks beyond just exploits to the code's overall health. Is it clean? Is it efficient? Does it follow standard programming best practices? Does it avoid weird coding patterns that might cause unexpected problems later, even if not strictly a security bug? Good code quality makes contracts easier to understand, maintain, and less prone to future errors, especially since they're often hard or impossible to change once deployed.
Get it right the first time. And the third step, test coverage.
This is super important for reliability. Developers write unit tests, little automated checks, to see if individual pieces of the code do what they're supposed to. Test coverage analysis measures how much of the contract's code is actually being executed and verified by these tests.
Why does that matter?
Because if parts of the code aren't tested, hidden bugs could be lurking there. High test coverage gives much greater confidence that the contract will behave as expected in different situations. The auditors looked at Plenty's tests, found areas that weren't covered, and helped them improve their testing, which actually uncovered some issues the basic code compiler hadn't caught.
So a proper audit is really comprehensive. Vulnerability hunting, code quality check, testing rigor. What's the bottom line for a user then? If a platform says it's audited, am I safe?
That is the million-dollar question, isn't it? The clear takeaway is audits are essential. Using an audited platform is way, way better than using an unaudited one. It significantly reduces your risk.
Yeah.
But an audit is not a magical guarantee of 100% safety.
Audited protocols still get hacked sometimes.
Unfortunately, yes. New attack sectors are found, auditors might miss something complex, or maybe the project team makes changes after the audit that introduce new flaws. So, yes, rely on audits as a critical piece of due diligence, but don't treat them as absolute proof against hacks. You still need to consider the project's reputation, the team, how long it's been operating without issues, and always, always practice good personal security with your own wallet.
Audit helps, but it's not a silver bullet. Prudent advice. Okay, let's zoom out one last time. We've got these complex staking and yield farming ecosystems. How are the powers that be, the regulators, dealing with all this?
Regulation. It's complicated and moving fast. The Hogan-level source really digs into this. The main theme is increasing scrutiny. Regulators globally are definitely paying more attention because these DeFi activities present new kinds of risks that just don't map cleanly onto the old financial rule books.
So are there clear rules for staking or yield farming yet?
Mostly, no. In most places, these activities don't fit neatly into existing categories like banking, securities dealing, or even the older crypto rules for things like exchanges or ICOs. There's a lot of ambiguity still, though regulators are actively working on it.
Why is it so hard to categorize? Staking seems a bit like burning interest, yield farming maybe, like with market making.
You'd think, but the technical details matter to regulators. Is staking custody? Well, maybe not if the provider doesn't hold your private keys. Is pooled staking investment scheme? Maybe it looks like it, but the argument is often that there's no active management in the traditional sense, and rewards come from the protocol, not investment profits. Is locking assets lending? Not really if legal title doesn't transfer. These nuances make applying old definitions really tricky.
Yeah, fitting square pegs into round holes.
Yep.
How are different countries actually handling it then? Is there any consistency?
Not much consistency, no. It's a real patchwork quilt of approaches. Hogan levels give some snapshots. The UK, for instance, actually provided some clarity recently. They said from Jan 2025, certain types of staking won't be treated as collective investment schemes. That's helpful. But anti-money laundering rules might still apply, especially if custody is involved. And rules about how these services can be marketed are definitely in play.
Okay, some clarification there. What about the EU?
The EU has its big MiCA regulation for crypto, but it doesn't specifically regulate staking as staking. However, parts of MiCA covering custody, administration, or advising on crypto assets could apply depending on how the staking service is set up. And EU regulators are definitely warning consumers about the risks involved, even without specific rules yet.
Switzerland.
Their focus seems to be on protecting customers if a staking provider goes bankrupt, recognizing that traditional custody laws don't quite fit.
And the US sounds like a battleground.
It's pretty unclear, yeah. The SEC has been active, using enforcement actions against some platforms, arguing their staking or lending programs were unregistered securities. But there's no clear overall framework agreed upon yet. Getting clarity on staking and lending is supposedly a priority for a new crypto task force there.
So regulation by enforcement for now. Any countries being more proactive?
The Bahamas is a really interesting example. Their DARE Act from 2024 explicitly defines and regulates staking services. If you offer staking there, you have to register, meet reporting standards, and crucially, provide very specific disclosures to clients about how it works and what the risks are. They're tackling it head on.
Wow, specific rules. That's rare. Singapore.
Singapore took a different approach. They put restrictions on platforms offering lending and staking services specifically to retail investors, trying to shield smaller players, but they haven't created a separate regulatory category just for staking itself across the board.
Okay, so yeah, truly all over the map. Specific rules, applying old rules, enforcement, consumer warnings, and taxes on top of this just make it even messier.
Oh, absolutely. Taxation is another layer of complexity and inconsistency. The Intertax SORC highlights this well. How staking rewards are taxed varies wildly between countries, and often the tax rules seem more driven by how do we get revenue from this?
Yeah.
Rather than a consistent understanding of the technology or legal nature of staking itself. It just adds more uncertainty for users.
It really feels like the tech is just sprinting ahead of the ability of legal and tax systems to keep up coherently. Is there a worry that too much regulation could actually be bad?
Yes, that's a real concern flagged in the Hogan Levels piece, even among some policymakers. Proof-of-stake networks need lots of people participating in staking to be secure and decentralized. If regulations make it too expensive, too legally risky, or just too complicated for individuals or smaller companies to stake.
Fewer people will do it.
Exactly. You could end up discouraging participation. That could lead to staking becoming concentrated in the hands of just a few very large players, which, ironically, could make the networks less secure and less decentralized, the opposite of the intended goal. It's a really fine line to walk between consumer protection and not accidentally crippling the underlying technology.
That's a fascinating dilemma. Protect people, but don't break the security model. Okay, we have covered a ton of ground. Staking, yield farming, how they work, the potential upside, the very real risks, slashing, smart contracts, impermanent loss audits, regulations. If you had to boil it down, what are the absolute must-know takeaways for anyone listening?
Number one takeaway. Yes, staking and yield farming offer genuinely interesting ways to earn passive income in DeFi. But number two, right alongside it, they come with serious, unique risks that are very different from traditional investments. You absolutely must understand these risks before you even think about putting money in.
And staking generally seems like the simpler, maybe somewhat safer path, but with potentially lower returns?
That's the general perception, yes. Staking is more directly tied to the blockchain's core security. The main risks are the price of the asset you're staking, being locked up for a while, and that slashing penalty if your validator messes up.
While yield farming is the high-speed lane, higher potential rewards, but more moving parts, more ways to crash.
That's a good analogy. Yield farming can offer much higher APYs through fees and token rewards, plus compounding. But the complexity is higher, and the risks are steeper. Smart contract exploits can mean total loss. Impermanent laws can silently erode your capital if you're not careful or lucky with fees and rewards.
So it's not about which one is best. It's about fit, right? Your knowledge, your goals, how much risk you could actually handle.
100%. The sources are unanimous on this. You have to understand the specific protocol or pool. How does it work? What are the exact risks involved with that specific opportunity? There's no substitute for doing your homework. Your choice has to align with your personal situation, risk tolerance, how long you plan to invest, how much time you're willing to spend monitoring things. Maybe diversification helps, a bit of staking here, a bit of lower risk yield farming there.
And underpinning all of it is personal responsibility. Do your own research, DYOR.
Absolutely critical in DeFi. There's often no safety net. Research the platform, look for those audits, but remember their limitations. Understand the tokenomics. Check the team's reputation if possible. Stick to more established players if you're risk-averse. Stay updated on the market, on potential threats, on regulation. Know the impermanent loss profile of your pool. Be vigilant.
It demands ongoing engagement, doesn't it? It's not entirely set and forget passive income.
Not if you want to manage the risks effectively, no. Especially with yield farming.
Okay, so let's wrap up with a final thought for everyone to chew on, based on all this complexity we've discussed. In this space where the tech evolves incredibly fast, often leaving rules and regulations trailing behind, where huge potential rewards sit right next to potentially catastrophic risks, how do you personally actually weigh the value of that potential passive income against the sheer complexity and the ever-present dangers of this decentralized frontier? Is chasing that high yield truly worth navigating the maze of smart contracts, the tricky math of impermanent loss, and the fog of regulatory uncertainty?
That's the question everyone involved in DeFi has to grapple with, isn't it? There's no single right answer.
Indeed. Well, thanks for breaking all that down with us today.
My pleasure. Always fascinating topics to unpack.